All right, what's up, everybody? What's up, tycoons? What's up, traders? Today's video, we're going to go over some very important data that you need to be paying attention to. We're going to take a look at those charts. Right, we're going to do a slideshow first, and then we'll hop into TLT towards the end of the video and really break down the chart and the price action and the key levels to watch for trading. So if you're new to the channel, make sure to subscribe so you can get access to these videos and see them. I'm dropping these videos multiple times a week. And don't forget to smash the like button, really help the channel out. So we'll just hop right into it. And some crazy stuff has been going on, guys. It's just been an insane market, and the Fed is hiking farther and faster than any time in modern history, right? If we look here, this is 2022, all right, and it's just a straight line up, guys. I mean, look at this. In 94, 95, it kind of zigzagged in this direction, but still not even as rapid as much of an incline, right? We can look at 99, 2000, 87, 89, 04, 06, 15, 18, and 2022 is just really outpacing it, right? And it's caused a lot of pain in the market, but there could be a lot more pain to come, right? There's no guarantees if the market's going to recover quickly. There's no guarantees that the Fed is actually about to cut rates. I like a lot of people really think that we're only going to get one more rate hike, and then rate hikes are going to be done, and they're actually going to start cutting sometime in 2023. That could be a possibility, but there's a high likelihood that rates are going to go up higher and stay higher longer than people are expecting and pricing in. If we go into the next slide, what we're looking at here is this is something that I've shown multiple times in this channel and on these videos, but we're looking at the National Financial Conditions Index and the Adjusted National Financial Conditions Index, along with the S&P 500 down here in blue. The reason we look at this is because Jerome Powell's goal right now, the whole reason that he's raising these rates so aggressively is he's trying to tighten financial conditions. And so when financial conditions are going to be tightening, you're going to see these two indexes start to rise, and you're going to see those go up. Now, it's not a coincidence that, a peak in these coincides with a bottom in the stock market, right? So over here, you can see, we get a peak, all right, and then we get a bottom right here in the stock market, right? And then it comes down, starts to go back up again, and along this way up, right, what does it do? It makes another bottom. Then we get another little recovery. We see financial conditions starting to drop. We get that recovery, and then boom, they come out here and they top out again, and the market comes down. So, the really important thing that people aren't realizing is that financial conditions haven't been this low and this loose since the Jackson Hole speech right here. And notice how that marked the top, right? And so I've been saying to people, and I expect to see these to start to curl up, okay, honestly, sometime soon. And as that happens, most likely you can expect the S&P and the stock market to continue this downwards trend. This is the really, really big and important part right here. The Fed fund rate has increased by like 275 basis points since this time. So all of those, these rate hikes, they take anywhere from 6 months to 18 months to really hit the economy and really start to tighten these financial conditions. So it's kind of wild to me that we've gone through this period of time and financial conditions have actually dropped back down to this time to where we were at the Jackson Hole speech. Now the stock market has gone lower, right, and prices have gone lower, but if we start to see these things curl back up again, it's going to be really, really dangerous and painful for the stock market, I think. So keep a close eye on those. That's something that I'm definitely paying attention to a lot. Now, right here, we just have a chart, and it's basically showing you guys just the massive pain, right? We have ETFs below their COVID lows, cannabis, China, and Kathy Woods, all right? The global cannabis ETFs, they're doing horrible. You have Crane Shares China ETF just doing horrible. All of these things are below their COVID lows, which is pretty wild, right? Pretty insane to think about that. A lot of companies have improved earnings over this period of time, but their stock price is actually trading lower than the COVID lows. Now, that's not to say for all companies. There's lots of companies who are doing really bad right now, especially fundamentally, and that's why they're trading so low. Right here, what we're looking at is the bonds. Okay, so this is the S&P 500 bond index versus the S&P 500 here in orange, and we can see for the first time in many, many years, both the bond market and the stock market are just completely trashed. Right now, me personally, again, none of this video is financial advice. I'm just showing you guys some data and then giving you my opinions on the data. But I think that the bond market offers a much better opportunity. Reason being is that a lot of the short term things. They're paying really, really nice interest rates, right? You look at like 3 years and 1 years, they're paying really good interest rates. And you can get that money risk free, or you can trade these, right? So as the rate hikes go up, right, and the rates go up, the price of the bonds are going down, which is resulting, in the bond market dropping so much. But if you do get that Fed cut, right, and the Fed actually starts to cut rates, then that's going to cause, obviously the rates to go down, and that will result in the price of the bonds going back up. So a lot of people, especially hedge funds and major institutional investors, they have a lot of attention, and they've been saying that, the bond market hasn't had an opportunity like this and hasn't looked like this good of an opportunity in ages. And I kind of agree with that, right? If we go to the next slide, we're looking at the tips. Okay. And these are supposed to be inflation protected, guys. These are supposed to be in the inflation protected treasuries. Okay. And they're down 20%. Okay. It's a huge sale on these. And it's been, tracking a very similar pattern to TLT that we've been tracking, this 5-wave move down. This has actually completed. We were looking to see if we could get a little breakout here, and we got a nice little breakout, but we're pulling back. This is a textbook look above and fail, and now we're trading back in this range that we established right here. So most likely it's going to come back down and retest the lows of this. And, again, down 20%, guys. So, I'm just showing you the tips right now because I've personally heard a lot of, institutions and financial advisors and stuff kind of mention that the tips. I want to say this is like one of the worst performances ever, if not the worst performance ever, in the tips, bond market. So, rates are going to rip higher, guys, and that's what I think that people aren't ready for. So the next few slides that we're going to be looking at are actually rates. Okay. In specific, this first one is the Japanese 10-year yield. Look at this massive explosion. Now, Japan has been the anchor really for the global markets, right, when it comes to interest rates. And recently, they made some big news about raising rates super aggressively. And look at this. I mean, you just see an absolute explosion, right? If we go to the Japanese 2-year government bond yields, we can see also it's having a breakout, right? We had this trend line here to the top side. We've broken out. We're retesting it, possibly continuing higher. We're really just looking to consolidate and stay higher, right? I think that that's a big possibility, is maybe not everything just continue to go up dramatically, but they're going to end up staying at these elevated levels versus coming down and reversing like a lot of people are anticipating and pricing in. If we look at here, this is the German government bonds, right? This is the German 10-year. We see it has a breakout here as well. This is the German 2-year, right? Looking very similar to the Japanese. Over here we have Italy. Okay, Italy breaking out on the 10-year. Or that was the 2-year. Italy 10-year right here breaking out. We have the Greece. This is the Greece. What is this one? The 10-year, right? Greece 10-year right here with the breakout. We see the Greece 2-year breakout. Spain even breakout. Spain again. This is the 2-year on Spain. We have the UK, even the United Kingdom, with a breakout on the 2-year government bonds. The UK 10-year breaking out, guys. Do you see the pattern now? Do you see the trend, right? And a lot of people just aren't really mentally prepared for this. Maybe they're overlooking some of these things. But if you look around the globe, rates are going higher, and most likely that's going to happen in the US as well. And all I hear right now is talks of the Fed cutting rates. So that's why I'm making this video. I don't think those are coming anytime soon. I could be wrong. And they may reverse things. Now, one of the reasons I don't think that they're going to cut things is that inflation is very sticky, right? So actually what we're looking at here is this is the Atlanta Fed sticky CPI 12-month chart. Okay. So this measures kind of like the sticky inflation, right? And as you can see, look at how high this thing is, right? And there's a good chance that it's going to stay elevated at and around these levels, right? The last two CPI reports, we've actually seen it trend down. But when you look at the Atlanta Fed sticky CPI, you can see that this is still remaining elevated. If we continue moving forward, look at it on a larger time horizon, right? We have not seen rates this high, or the Atlanta Fed sticky CPI this high since the 90s, guys. I mean, that's the last time we were at these levels, and now we're trading much above those levels. If you actually take a look, we're really close to over here, and we're still even higher than there. And what time? This is the 70s, right? And this is the Volcker. This is like the bottom of the Volcker area right over here. So, there's a really good chance. And notice this is what really happened with the 70s and the 80s, right? We see it came up really high, okay, and then it starts to come down and they cut rates and then inflation just skyrockets back up again. So, everybody's saying that inflation rates could have been peaked, and CPI may have peaked and it could be coming down, but inflation could be a lot more sticky than what everybody thinks. And if they try to reverse policy too soon, we could see inflation skyrocket back up, just like we did over here, where it came back down and then skyrocketed back up. Now, another thing we're going to look at is going to be core, okay? Because, the Fed is really important and focuses a lot on core. And so this is basically the core sticky CPI. And we can see very, very elevated, guys, really, really high levels it's not been at in years. It is starting to peak a little bit, but there is a potential this thing could go up to like 6.5. And, this is just a little bit of a time chart here. Okay. Or actually, I'm sorry, this is core sticky CPI excluding shelter, right? And shelter has a large part to do with a lot of this. And a lot of people are predicting that shelter prices are going to be coming down in 2023. So, there is a good chance that as that happens, you will see things come down a lot more. If you look here, this chart does show much more of a peak once you exclude shelter and take shelter out of it. You really start to see, the downtrend. But the whole purpose of this is that, inflation is very sticky, okay? And it really could stay sticky and stay higher a lot longer, than people are wanting, right? Just because we're starting to see a downtrend and we've seen a possible peak, that doesn't mean that it's going to completely U-turn and go straight down to zero. If you take a look, this is the same thing. Okay, this is the core sticky CPI, but it's on a larger time horizon. And again, right since the 90s, guys, we're at levels that we haven't seen since the 90s. Okay, and we're actually retesting these previous levels here, from the 70s. Okay, so just so you guys can truly understand, how historic these times are, right? This bear market that we're in, this is going to be studied and analyzed for the next 20, 50, 100 years. People are going to be looking back and evaluating the Fed, and so that's on the Fed's mind, right? And they don't want something like this to happen, where inflation goes to record levels and then it collapses, and then they don't want it to go right back up, right? So that's their main goals. They don't want to be remembered as the people who let inflation get really high, cut it, brought inflation down, and then let it get really high again. That's basically their goal and the legacy that they're trying to not leave behind and not be remembered for. That's something that I really think a lot, and that a lot of people just really aren't thinking about. If we look here, this is PCE, okay, personal consumption expenditure, and then we have the Fed effective federal funds rate. All right, so this is the Fed funds rate over here with the PCE core CPI, and you can see that this is almost, the Fed funds rate is almost higher than the core PCE. All right, so that's something that's really going to be interesting to watch, and you can see here kind of how it correlates, right? Normally it's below, right? And a lot of times it's below this. And then, over here, when we have the free money, that's when all of this is up above. And really, then we had the free money here again when the Fed fund rate is at zero. As you can see in all this time period here, it was just right at zero. And this thing is just skyrocketing up aggressively, right? And it's looking like it's going to get back above, our core PCE. So I think when that happens, it's gonna be really interesting to see if this gets inverted. I think this will get inverted. Personally, I think that's what's gonna happen. If we take a look over here, this is actually the PE ratio for the S&P 500. Okay, that's what this is right here. SPX index, best price to earnings. All right, and then we have the US 10-year index. And what we're really looking at right now, this is another inversion, guys. Okay. So if you look here, right, we have the 10-year, okay, up here above S&P 500, earning PE ratios, right? And take a look here when that happened, right? You see the 10-year starts above, all right, our S&P PE ratios, and then we see a crash in the S&P, right? And then those start to decline, all right? The 10-year goes down, and the market kind of will go back up. And that's just something that we need to be cautious of, right? Is that, a lot of people haven't really priced in a big earnings crash and a big earnings recession. There's actually some theories that, earnings could be relatively flat next year. I'm not really too opposed to that. I do think that, that's a strong outcome possibility. But, you have to be cautious. You have to be prepared. If, the PE ratios are going to just tank dramatically, and start to really go down as the last time when we inverted over here, and we saw the 10-year above it. That's definitely a possibility that people really need to pay attention to, and start looking at. And this kind of just is a very similar thing. Okay, this is actually the 2-year Treasury yield versus the federal funds rate. I think we looked at the 10-year earlier, but this is the 2-year and then the Fed funds rate. And we can see that there's an inversion right now. It's now inverted, and this is not a good sign for the market. Okay, so you really need to keep your eyes open, really start paying attention to some of the other data that people aren't really much paying attention to right now. A lot of people think that if you look at it, okay, this is telling the market is telling the Fed to stop hiking. Historically, a Fed fund rate 2-year inversion kicks off a chain reaction in Fed policy and fixed income. And this is one of the things that's saying, hey, the Fed needs to cut their interest rates, right? And that's why a lot of people are saying that. They're looking at charts like these. And the reason being is because, it's going to cause massive pain to the markets, right? And it's going to cause a lot of devastation. And, the bond market is fully pricing in a recession in 2023. So this data right here is just showing and giving them signals that, hey, like, you guys need to stop raising these rates so aggressively because, things are getting bad, right? But if we look at those sticky, CPI reports and things like that, like I said, Jerome Powell and the Fed, they don't want to be remembered as the people who, let inflation get super high, calling it transitory. And then as soon as it starts to decline, they let it rise right back up, right? They're really trying to tame this inflation and really get it down. That's their main goal. So even though we have signals here telling them, that people are looking at saying, hey, they got to stop hiking now. They need to start go ahead and actually cutting. Some of the other stuff that we've been looking at here, we looked at a lot of the global rates. They're still going up, guys. And people aren't really cutting the rates. We looked at a bunch of different countries, looked at Japan, Greece, Italy, Germany, Spain, the UK. And a lot of those things are telling me that rates are going to go up, even though we have these signals here saying that they should be kind of reversing and stopping the rate hikes. So you kind of have to keep all of this stuff in mind and not be too biased and look really only at one data set. That's something that can really cripple you. This next chart that we're looking at is this is going to be the S&P, forward earnings per share. Okay, and that's going to be what this is right here in black. Okay, and that's what we're looking at. And if you look, they really haven't priced in a very big decline in forward earnings per share in the stock market. And a lot of people think that either earnings are going to be flat, right? And that's kind of what this is pricing in here, or they think that we're going to see a possible earnings recession here in 2023, whether it's between Q1 and Q3, that there could be a massive earnings recession. So you need to be again just prepared for that and kind of realize that, hey, maybe the market's a little bit too bullish, right? I mean, we've seen a big decline in the actual price of the S&P 500. That's what we're looking at in blue. But when you look at the forward earnings per share, it really hasn't declined very much. And from the peak right here, from the stock market top, it's actually still elevated. So even though the market has dropped a bunch, forward earnings per share really hasn't seen much of a drop. So I wouldn't be surprised really if we start to see a decline in this, as we start to see an overall decline in the stock market as well. Now over here, the next thing that we're going to be looking at, this is this is the average EPS drawdown. Okay, so average earnings per share decline. And this goes through all of our bear markets over here, right? So we had the COVID bear market, the COVID crisis. That was a very, very short, like only 2 months of contraction, right? But your average earnings per share decline is 30%, guys, negative 29.5% on average, right? If you look at the '08 financial crisis, look at the earnings per share change right here, down 91.9%. And we're definitely not pricing that in, right? If we look at the chart that I just showed you guys before, it's definitely not pricing in, anywhere near what potentially could be due to come, right? And it's been brutal, right? We have the O1 right here, down 54%. And we have the 90s right here, down 36%. And in the 70s, all right, if we take a look, the 70s and the 80s, which a lot of people are comparing our times with, maybe this is what they're looking at, right? Maybe this is why they're a little bit bullish, is because the actual earnings per share change was below 15% in all of these. So, again, the average is negative 29.5%, roughly 30%. And a lot of that has to do with, '08 and 2000, the dot-com crash and stuff like that, where you see these really, really big numbers and big aggressive numbers. And maybe this is what they're looking at, and this is why they're a little more bullish, is they're looking at the time periods between the 70s and the 80s and saying, hey, EPS change really went down by about 15% or less. So if you take a look at the next slide and chart right here, this is actually going to be, the banks, right? And a lot of this top firms out there. Okay. Specifically, if you look at Tom Lee, and Tom Lee is famously known for just being a perma bull. He thinks that the S&P 500 is going to end the year in 2023 at 4750. And if you look at all of these prices, really, I mean, most of the banks have them all above 4,000. Morgan Stanley has it right here at about 3,900. We see Scotiabank with some similar numbers. UBS, Barclays has 3725 on it, which is actually below where we're at right now. And so, if you really look at this, right, the top majority of these banks, like 70% of these banks, are really, really bullish on the market for next year. So that kind of just suggests that, hey, they're thinking we're going to bottom sometime, right? And remember, I told you, it's all because they're looking at a lot of data and they're saying the Fed, it needs to cut rates. They have to cut rates right now. But a lot of the data that I've shown you guys in this video between, international rates and, sticky inflation charts, sorry, really suggests that they're going to either, keep raising rates higher, or they're going to keep those rates higher for a longer period. And that's going to affect the stock market, and that's going to affect the bond market a lot as well, right? The bond market is directly correlated, and everything that, the Fed is doing with these interest rates directly affects the bond market a lot more than the stock market, right? A lot of the stock market is just it's earnings per share, and then it's future guidance and growth, right, and things like that that they're looking into it. But when it comes to interest rates, right, the bond market is much more massive, like way more massive than the stock market, and that's what's being directly affected. So that's why we look at TLT. That's why we like trading TLT in some of the bonds, because again, everything the Fed is doing directly correlates to those. And as interest rates go higher, then the price of those bonds are going to go lower. So we'll go ahead and jump into TLT. And so, looking at TLT, the main thing that we've been tracking this whole year that's been playing out really, really well is an Elliott wave, 5-wave move to the downside. We have 1, 2, 3, 4, 5, taking, TLT possibly to about 80 to 90, but before potentially seeing a bottom somewhere in that range. Now, we may not bottom there, right? We may continue to drop even more. That's definitely a possibility. But the way that, this Elliott wave pattern works is your wave 1, your wave 3, and your wave 5, those are all going to be 5-wave impulsive moves to the downside. And your wave 2 up and your wave 4 up are ABC correction waves. And so that's been playing out perfectly. We see we have 1, 2, 3, 4, 5 down, and we get an ABC correction wave up right to our 3 major retracement levels. And then we come down with another 5-wave pattern to finish off wave 3. We got ABC up. That's our wave 4. We got a perfect rejection at our 61.8 major retracement level, and we've started our wave 1 down, and we're looking for a possible wave 2 bounce sometime in the next, coming days or weeks. I wouldn't be surprised to get some type of a bounce ultimately to continue heading down lower to that 80 to 90 range that we're looking at. So if we zoom in some more, the main things that we're really been looking at to go ahead and give us some confirmation is our major fib retracement levels, the 61.8, the 50%, and the 38.2. Those have been working like a charm very, very well. And then really the MACD sell signal. So right here is when we got our MACD sell signal. And this was on, what date was this? This was Friday, December 16th, right? And it's January 1st right here at the time of this recording. Happy New Year's, by the way. And you can see after we got the MACD sell signal, TLT has completely just puked, right? It's down a whole lot. Broke through our major support level right here at 102.94. And I believe the last video I did on this was calling for a dead cat bounce, right? And the reason being is because there's this major trend line that we've been respecting. I'm not going to zoom out and show you guys, but we've been rejecting this trend line multiple times, right? And we got a rejection here again. And what we did and what we're setting up for now is a very bearish setup known as a look above, right? And then a fail. So if we, break through this trend line here to the bottom, it's going to be a very, very bearish pattern, and signal basically is what we're going to be looking for. But for right now, it does look like we're getting a breakout and then a slight retest, right? When I made that dead cat bounce video, we closed right here on the day. And, I dropped that video in the morning and say, hey, basically, I do expect some type of a bounce. To me, it looks like we personally have finished our wave one down. But as I said, it could extend further and we'll readjust these. I drew these things up here. I had this ABC and this 1 2 3 4 5 before the candlesticks were even here. I'm just tracking the overall pattern, so I'll adjust it and fine tune it as things go on more. But it definitely looks like we could have completed a wave one and we could get some type of bounce to potentially fill these gaps up here. Now, one thing that I want to mention that someone liked is a half gap fill is very, very bearish. Okay. And when it's a gap up. So if you look here, we gap down and then we came up here and got half of that gap fill. We came right to the center of this gap and then we got a huge move to the downside. So pay close attention, in the following weeks. The gap has really been a strong resistance level, honestly, right now. But if we do start to creep up into this gap and we only are able to come halfway through this gap right here, what price level is that going to be? Let me get it for you guys. That's going to be right around 101.50. Okay. If we close around 101.50 and we're not able to push higher, then that's going to be a very bearish signal and indicate that most likely we're going to ultimately break this trend line and come to look down to fill this gap down here. Now, this gap is anywhere from 96.63 down to about 95.06. So we'll just call it 95.96. And the same thing, if you see a half gap fill, then most likely there could be some type of bounce, right? If we come down to half of this gap and then try to reverse, that's going to look, short-term bullish right there. But overall, I'm looking to see, are we going to break through this trend line and get the look above and fail? Because if you get a look above and fail, it's going to put you back in this range that we've been trading in. And, obviously that's below this trend line, right? We've been staying in a range below this trend line, really just making lower lows and lower highs. And here is we're setting up for a look above and fail, and possibly to come down and fill this gap and ultimately complete our 5-wave move to the downside between about 80 and 90 on TLT. So appreciate you guys watching the video. If you made it this far, I really thank you guys a bunch. Don't forget to smash the like button and subscribe to the channel, and I'm out.